In our third installment tonight, we're taking a look at specialty mutual funds. If you have a 401k, you probably know something about your mutual funds where your stocks are often diversified in a relatively safe portfolio. By comparison, specialty funds do what the name suggests. They specialize in industries or regions and are a little more risky because they offer less diversification. But not everyone has the stomach for specialty funds. We spoke to financial advisor Doug Flynn, co-founder of Flynn Zito Capital Management, about this. I started by asking if there's a difference between a specialty fund and a sector fund.
Well, it's actually interchangeable. Any kind of thing that you want to focus in on or sector out is a specialty fund by nature. So.
All right. So, but doing it in a fund still allows you diversification. So if you're getting excited about some trend, fracking being a good example, you want to be able to do it with diversification.
That's right. And so you might already own the index in your 401k, and as an example, there's 10% of the index is energy stocks, 17% right now is technology. But you might want to take a bigger stake in energy or technology or any of the other sectors. That's an easy way to add in a particular index or specialty fund or sector fund that will add that exposure there for you. You can add additional money there and you'll have a little bit of a higher weighting, but that's just one example of the type of specialty funds that there are.
Well, one of them you talk about is country-specific funds, country or region-specific funds. And I'm conflicted about this because you take something like China, for instance. The stock market in China hasn't actually done that well.
No.
Well, you know, it hasn't matched their economic growth. And if you take one of these ETFs that piles on countries in China, you might think you made one of the best investments going, and you look at it 5 years later and you haven't.
That's right. And so you might say specializing into a particular country might not be the best thing. I think you already have to have some basic international funds in there, and then you sector this out with 3%, 5% is a good measure to do that. You don't want to put your entire international exposure into any particular country. Interestingly, the most common index that's used in the international is the EAFE, the EAFE is the most common one. But that one, and you think about it as a world index, it's the most common one, doesn't include Canada. So,
interesting.
Yeah, I know that you would appreciate that.
Right.
But we're saying, why are you excluding Canada, especially with all the energy? And so you can find other types of international funds that have that in there. It's the EAFE Plus. And there are other types of things, or you might want to just buy the EAFE because you already have it. It's the only fund that's available in your 401k. And sector out with a Canadian fund or something like that.
People are always asking me about socially responsible funds. And that's a tough one because my socially responsible and yours are two different things.
Sure. The most common example of socially responsible are people, or if you have a religious belief or something, or something that you want to not have tobacco stocks, or there are funds that specialize in screening out these types of things. Conversely, there are funds that specialize on investing only in those things that would be screened out, such as tobacco and other types of gambling. And so you might want
sin funds.
You could buy a sin fund that specializes in it, or you can do socially responsible, they call it, which is going to exclude that. It's arguable whether that brings additional return. I think there are times when it does, and there are times when it doesn't. And most people are most focused in on what's going to bring me the most return on my money, and then I'll do with that what I want myself. But there are people, absolutely, and we have some clients that this is very important to, that we will use additional screens to pull that out so they're not investing in those things against their beliefs.
You and I have spent a lot of time over the years talking about alternative funds, things that are not mainstream investments. What kind of options are there out there? The reason one would consider this is, let's say you're getting into a market right now. This market's been going strong for a while. You want to get in, but you want to hedge a little bit.
Sure. So that's where alternative funds can come in. Some examples of that might be a long-short fund, which means most investments that you buy are typically long only, and what that means is
you're betting on the fact that it's going up.
That's correct. But what if it goes down? Or when the investment manager is doing their screening, they find a whole bunch of stocks they like, they buy those long, and then they find in their screening that there's a whole bunch of stocks they don't like, they think are going to go down. So in that fund, they can buy both. That's an example of an alternative fund. A traditional fund is not going to have that.
And by the way, if you went short on your own, you could be on the hook for a lot more than you invested. Whereas if you buy it in a fund, that's all you can lose.
You're only limited to what you put in, but shorting outright is extremely aggressive, and it's an unlimited amount of money you can lose because technically the market could keep going up forever, and that's why on the inverse you could lose an indefinite amount of money.
Well,
so you have to be very careful.
I think we'll keep that for another topic. We'll talk about shorting and why it might be a good strategy, but it's not one to be careless about. You got to be very responsible.
Or doing a fund where you have somebody doing that for you.
You're talking about leveraged funds. What do you mean by those?
Well, leveraged funds are now going to take a particular area and say, not only go in at 100%, but I'm going to magnify that return. I'm going to go in 150%. So if I think a particular market or index...
You think the S&P is going to go up 20% this year?
Correct. So if you think that and that's your bet, you might say, well, with the same amount of money, I can leverage that. You can either do it yourself in margin, and then you get into dangerous territory, or you can buy a fund that buys 150% of the S&P, or 200%, or more.
So if the S&P went up 20% and you had a fund that has 200%, 2 times return, you'd be up 40%. There are some fees involved. As you get into these more complicated things, the fees tend to get higher.
It gets higher, and also those are daily changes.
Yeah.
So you could look a year later and see the S&P up 20 and say, I didn't go up 40 because it's a daily change. So those are trading vehicles. Those are not long-term investment vehicles, and it's really important. If you believe there's a short-term move, that's what they're for. All of these companies that use leverage will tell you this is a trading tool, not a long-term investing tool. So have a buy time, but also know what you're going to get out with. What is your sell strategy? And when you hit it, take that off the table.
And by the way, you can do the same thing on the inverse. If you think the major indices are going down, you can buy stocks that'll mirror it. That'll be the reverse.
That's right. If you think it's going to go down, why not only go down one time? Let's magnify that. That is very dangerous also, but if you're right, you can make money. But again, that's why it's a short-term trading strategy.
All right, Doug, good to see you. Doug Flynn is a co-founder of Flynn Zito Capital Management.